Welcome. I'm Gabriel Church, and this is the ArkStone podcast, where faith, stewardship, and financial wisdom come together to help families build wealth with purpose and create a legacy that lasts for generations. Every week, we explore strategies, principles, and conversations that challenge conventional thinking about money and empower you to take greater control of your financial future. Today, we're diving into one of the most powerful concepts in the personal finance: the living legacy account. What if the same tool designed to protect your family could also help you build wealth, access capital, reduce dependence on banks, and create a multi-generational legacy? Most people have never even been shown that possibility. That's why we're here. So joining me today is my friend, financial strategist, and co-host, Teddy Dotson.
Thanks, Gabriel. Love it. And I'm really excited for this conversation because this concept has the potential to completely change the way people think about money.
Absolutely. Whether you're hearing about the Living Legacy account for the first time or you've been researching infinite banking for years, today's conversation is designed to help you understand not just how it works, but why it works. So grab a notebook, lean in, and let's talk about how to become a better steward of the resources you've been entrusted with. Welcome to the ArkStone podcast. All right, Teddy. So when we think about the Living Legacy account, the first thing that we really want to do is we want people to understand where it comes from. So I'll kick it over to you. And if you could begin to explain what the financial tool is, the product, or the means of getting yourself into a Living Legacy account.
Yeah, so thanks for all that. Thanks for having me here. Man, really excited about this. And some people may not because they may have been started the wrong way. And really, now don't get the wrong idea now, but it's actually life insurance. And the thing is, like, the wealthy have been doing this for over hundreds of years. If you guys know anything about the Rockefellers, Walt Disney, and big companies and big families like that, then you would know. But I always advise people to do your research, right? Get to know. But we're not here to give you no fluff, and we're not here to BS you or tell you no lies. We live on the mission to overcommission faith and finance, right? So what we want to bring is straight clarity, transparency, and tell you the truth. So we want you to look at us the right way and not just say, oh, another one of these guys, these gurus talking about this stuff. Because no, we ain't gurus. None of that stuff. We're just real people trying to let people know real things. But really, it's a whole life policy, whole life insurance policy designed and structured specifically in a way that you can reap the benefits while you're alive. It's kind of like having your own bank account within this policy in a way where you can build actual cash value. Yeah, I like to call it like four things you could get in this: protection, because it is a life insurance policy; liquidity; growth, which is uninterrupted, right? The growth, you could use your money and borrow against it uninterrupted; and flexibility. Protection, flexibility, liquidity, and growth. You can get all these things within a life insurance policy, a whole life policy. Now, there's a lot of back and forth about, like, oh, people talk about they can do this with terms and you know what I mean, get cash value out of terms. And then there's a lot of arguments on IULs and then whole lives. But we're not going to go into that. But basically, you can design, or we can design for you, a whole life policy to where you can live and use the living benefits now, right? And you build that cash value within that part of the policy, which is your paid up additions. So, yes, it carries a death benefit for when you do pass, and you can leave that to your generations and generations. It's just what the Rockefellers have been doing for a long time, and families still do it to this day. It's just not widely taught. It's not in our education system per se, right? That's kind of just the short end of it.
Awesome, Teddy. Okay, so I'm going to go ahead and break down real quick everything that Teddy said into three buckets. So every whole life policy or living legacy account is broken down into protection, which we'll be referring to as the base. The base is what you would get when you leave Earth, right? You pass on, there is a base policy. That is the protection side. The death benefit is wrapped up in that. Then we have a second bucket, which is the PUA or paid up addition, also known as a cash value. The cash value is what Teddy was saying has liquidity, flexibility, and it's what grows. Then the third bucket is a term. That's a term rider that is added onto the entire policy so that we're able to fit more cash value inside of this policy so that you can begin to pay up those additions so that you have the availability to cash value. And then that wonderful piece that Teddy was mentioning, which would be compounding interest in the forms of paid up addition, in the forms of dividends. And the most beautiful thing, when you borrow against these policies, you don't lose that compounding effect. So, Teddy, when we're thinking about protection, which was the first thing that you had mentioned when we spoke of these policies, can you break down what protection is to the audience?
Yeah, the first part of the protection is the base, like he said, or face amount, right? Is going to be the death benefit side, which is going to protect you when you pass on, and protect your family financially, right? But there's another part to it too, is what called either accelerated death benefit or living benefits. And it falls under about three categories, depending on where and what carrier you go with and how it's structured. Is chronic illness, terminal illness, and then critical illness. So if one of those three categories were to happen to you, you have the opportunity and the ability to be compensated through the death benefit side, not the cash value side yet. Okay. The death benefit side, whatever's built up, whatever you're paying for. And the good thing about a whole life policy is like your death benefit isn't like one amount, right? It may start at one certain amount, but it grows over time too, as well as your cash value. So say if something were to happen to where you can't go to work because you hurt yourself, you know what I mean? And you can't put your shirt on or tie your shoes, then you won't be able to work, right? You could go and get disability from the state or whatever, or workman's comp from your job, which is going to supplement part of your income, right? Maybe 80%, 90% at the most, right? Well, within this policy will pay you out a good amount of money every month, or a big chunk, so that way you don't have to worry. That's a part of the protection side. One story I always like to tell clients is, we have an agent on board, and they had a policy, right? Their dad had a policy. Well, dad had got diagnosed with terminal cancer and had so many months to live, right? Well, they went to the insurance, let the insurance know, and the insurance paid out that death benefit. Miracle happened, right? Thank God, right? Thank the Lord God, because miracles do happen. And he beat that, still living to this day, but never had to worry about that money because he got cashed out that death benefit side. And no harm, no foul. They didn't come back and try to get that money. And the good thing is he didn't pay no taxes on that. So when it comes to protection, that's a big part of it. And then I would say another protection side is like having access to funds when you might need it for emergencies, right? And that's where you can go to the cash value side. and which is not really a protection side, but I can look at it as use it as protection too. I mean, if you need some more funds for something, maybe you need to purchase a car or do have a big renovation for your house, or something breaks on your car and it costs you 5 to 10 grand. You don't need to go to the bank and borrow that money. And if you don't have the money in the savings, which you should, I always advise you should have 3 to 6 months emergency just in case. But just in case it's a little bit bigger and you want to take advantage of a policy, you can't go borrow against it.
Thank you, Teddy. 100% I agree. There's also this side that we were talking about called term. And the term is something that you can pay into. It's a insurance that you buy for a set amount of time. That's why they call it a term. It's a term length. Most of the time it comes in a 7, 10, 20, 30. There are some companies out there that will give you a 40-year. It's a little bit less expensive than the whole life. A whole life is what we call a permanent insurance. So that death benefit is something that you pay for. You get, I'm 41 years old. I'm going to be 42 here pretty soon. So if I was to go get a whole life, I would get it set for right now, my health rating, my age, and they would give me a number. This is how much I'm going to pay a month. That carrier will then allow me to pay that until the age of 120 years old. That's why they call it a permanent life insurance. Whereas a term, they would give me the same rating for this time. However, if I had a 10-year, I'm going to pay a significantly less amount of money than for a permanent insurance. This would be a little bit of an increase for a 20-year, 15-year, 30-year. Now, we can tack this on to the whole life living legacy account. And the one thing that I would say why we would look at this as a protection is we can get a much bigger amount of coverage because the insurance company knows that more than likely you're not going to die in that term. It's there just in case, kind of like car insurance. Nobody plans on having an accident, but when the accident happens and you're not covered, you're sure going to wish that you were paying. So that wraps up really the protection side. We have the base, we have that permanent that we pay for every month or annually, and then we have the term, right? The term is a bigger protection and we have it for a set amount of time. Now, some people have asked me, why would I want to spend more money on a term? Because there is that middle bucket, the cash value or the paid up edition. And in order for us to make sure that we adhere to IRS codes, there is a specific thing that happens if we put too much money into a policy and then Uncle Sam, he shows up and he wants his cut. These are tax advantaged life insurance policies. This whole life policy allows you to not have to pay taxes because of the specific codes that are written. But if we end up putting too much cash value and we don't have enough protection, then we mech. That's a modified endowment contract. And Teddy, what would you say is the best way to describe a modified endowment contract?
Yeah, first it would just defeat the whole purpose of trying to have your bank, right? Because then you got to pay taxes on it. But it basically becomes more or less like, how would I explain it? A bad 401k or IRA or something like that, to where they're going to tax you as much as they can, and basically come and be your business partner and take a big chunk of that money. And then now you're paying taxes on a vehicle that you normally and don't want to pay taxes on. And that's one of the main reasons why people use this. And it's to get away from paying so much taxes, because all the money you use within this cash value is yours, right? Even if you don't use it, but you borrow against it, like Gabe had mentioned, and that bucket is really yours, right? And you're not borrowing it, the money itself, you're borrowing against it. And if it's designed correctly and we're avoiding that MEC, the modified endowment contract, is basically we're just carrying enough insurance, term and base, combined, structured right, designed right, to avoid that. That way you can put a bunch of cash into that bucket, right? Which is basically, I always like to call it your bank account or my bank account inside my policy. And I get to use that tax free whenever I want. Uh, and Uncle Sam can't really say nothing. Now, if you fund it too much in a way where, kind of those two meet and that making becomes right there where it's going to be a modified endowment contract. We help you to avoid that, and we put up safeguards because we don't want to pay taxes. And that's the big thing. Uninterrupted growth, tax-free, money that's liquidity to you and flexible. That's the whole point of what people will call like infinite banking concept or your family banking system. What we call it here is a living legacy account.
Thank you, Teddy. So for all of you out there, now would be the time that I would like you guys to really drop inside of the comments. Have you heard of infinite banking or IBC? Specific individuals like Nelson Nash. There are a couple of companies out there that really do an amazing job. I'm going to go ahead and plug Better Wealth. They're a company that does that. Garrett Gunderson, he's somebody that really pushes hard into it. And there are a lot of individuals that I would say you can go educate yourself with. We're not the only end all know all here for sure. There's Cash Flow to Legacy. That's a podcast that we're a part of with a partner company, Bankonomics. There are individuals out there. But what I love about what Teddy and the team here at ArkStone does is we definitely take the mission over commission and we put your goals first. Not everybody's on the same page. There is no fad diet, one size fits all. So our living legacy accounts, our LLAs, as you'll hear us call them here in the future, they're designed in such a way that maybe you're just getting started. Maybe you're like, life insurance, I can barely even afford to go get food from the grocery store. Why am I even going to look at life insurance? My car's not even insured. But that's where we want you to really dive into the comments. Let us know. Tell us some situations you have. Reach out because we can help you. And we can help you without a charge. There's no cost to come and get clarity. But I want to talk about what most people get excited about. What Teddy really touched on was that uninterrupted growth, wealth protection, and an opportunity to put your money in a tax-advantaged account where you know what's yours. You know what you can borrow against. You know what is available to you, right? And then the paid up edition, as Teddy was saying, we can be far too aggressive. And sometimes we can pay for way more protection than we need. And here's where it gets really spicy. And a lot of people start to disagree and the industry has gotten a bad name. There are individuals out there who care more about what they're going to put in their pocket off of a living legacy account, an IBC, a whole life than what is best for you. And you have to be careful with that. You have to double check. You have to make sure. And here's the best place that I can tell you. If you get a policy written up by somebody and it is a whole life or it is a, index IUL, right? You get an index universal life. There is a way that they can write these up, these agents that you're working with, that they still work for you. Now, I can write the same policy that someone else wrote for the same amount of money. And depending on what you need, if you need protection, if really what you're looking for is, I want to make sure that no matter what, when I leave Earth, I'm going to leave a legacy for my family. That is very important. That's why we call these living legacy accounts, because the truth is that you might need something that leaves a legacy and you're not worried about cash value. Now, if that's the case, fine. We write that up in such a way. Maybe you don't even need permanent insurance. Maybe a term works fine for you. And there are such things as convertible terms that you can then convert later after you get more education. But your goals matter. At ArkStone, we make sure we take care of that. Now, if you're looking for family banking and you're ready to run aggressively, PUAs, term, and base, right? There is a number that we give people, right? The base versus the PUA. The base being the term and the base protection together, what you're paying for there, and then the cash value or the paid up addition. And we like to start by making sure that in a good living legacy account where somebody isn't looking for heavy protection, they're really trying to do a family banking, we like to spend 20% of every dollar on protection, 80% going into the cash value bucket so that you can see your policy grow. You have the opportunity to borrow against that. There are bigger and better splits. Again, I'll say splits, and then I'll kick it over to Teddy because Teddy is one of our top wealth strategists, and he designs policies in such a way that you get maximum attribution to the cash value bucket, but at the same time, avoid any opportunity to take that whole life policy that you're going to use for family banking and turn it into a modified endowment contract where you're going to end up paying 40 to 60% in taxes, and you're going to lose all of that opportunity. Now, don't hear what I'm not saying. There are opportunities out there where a modified endowment contract might work for you, but for most cases, we want to stay away from that. It's not a bad word, but it's not something that we want to use if we're trying to do a living legacy account or a family bank. Teddy, can you break down the split a little bit deeper than what I just gave them?
Yeah, so first and foremost, I just want to say like age and health is going to matter first. That's going to affect the split first and foremost because the older you are and then the health, right? That's going to help you with your rating, which means the cheaper the insurance, the better, right? And that's going to be the base side. Now, when it comes to splits, we always start with like around a 20/80, like Gabe says, 20 cash value, 80 insurance. 20 insurance, 80 cash value, because that's what most people want. Usually they want a certain amount of death benefit or less death benefit they can get as they can, and the most cash value they can get. So it's kind of like you're putting your money in a bank and getting protection at the same time, which try to do that at a regular bank and then try to borrow against it at a regular bank. It's not going to work, right? They're not going to let you. They're going to want your credit, all that good stuff. But it can be split all the way, like 100%. Split it 50-50, 60-40, 30-70, and vice versa, right? But it's all going to depend on you getting approved first and locking in your health rating. Why we always start at a 20/80 is because that's a very good starting point. Now we can push all the way to like 90% cash value, but a healthy starting point is that 20/80. And why that is because you're not pushing it all the way to that MEC point, like Gabe had mentioned. And then you have a little bit more flexibility and room. Say you wanted to put a little bit more extra money, you'll have an opportunity to do that without pushing that MEC and having to pay taxes. And then the big thing is you have 80% of your money to borrow against. And that's where the power really comes in of the family banking, infinite banking. And what we are going to say a lot is that LLA, the living legacy account. Because we want you to use it now and live that legacy now and leave that legacy. And the big thing is, and we'll probably dive into this in another episode, is, how to have that money inside your account, borrowing against it in a way where you're having it work for you, right? Because that's the biggest thing. Why do we borrow from the banks, right? To make purchases and all that stuff. But what if we could borrow against it and make that money make money while our money is growing uninterrupted in our cash value account, our bank account within our policy, protected, growing uninterrupted, compound interest, and making dividends every year. Then we put that money into something else, making more money. Now you're basically splitting your dollar into two places at one time. It's not very many places you could do that. I hope that kind of clears it up a little and helps you get a more grasp on how it kind of works.
Yeah, absolutely. Thank you, Teddy. So here's something else that I have found to be a pretty serious topic that a lot of people do not talk about. Okay. Now, you'll hear agents say investment, investment, investment. Teddy, what is a living legacy not?
It is not an investment.
It is
It's a
not.
great, yeah, it's a great vehicle to store your money and have it protected, but it is not an investment. When that mech comes, then it's an investment, right?
So whole life is not an investment. So if you're looking to invest your money, and we've heard of a BTID, buy term, invest the difference. There are some specific pretty powerful individuals out there that help people, manage their money and without dropping any names. I'm not going to say that a whole life policy with cash value is an investment. If you want to look at it as an investment, it's a terrible investment. It's got a very low rate of return comparative to the market and some specific opportunities you have. And why is that? It's because there are guarantees. There are guarantees inside of a whole life policy or permanent insurance. One of them is you are guaranteed to get exactly what you are told in a contract when you die or leave Earth, right? Or the living benefits are activated. You're guaranteed to get what the contract says. You're paying for insurance, okay? You're not going to get that in the markets. However, if you're looking at a whole life policy, it's a wealth protection / management vehicle that gives you the opportunity to compound your money and let it work in two places. So can you use a whole life policy for investing? Absolutely. You could borrow against the money, go into the real estate market, and you could put it on a house and invest there and get a much greater rate of return. But I would not ever say to somebody, hey, come over here and invest your money into this whole life policy. No, because it's first and foremost protection. We are making sure that we are guaranteeing our legacy will have a leg up when we leave because of what we're doing now while we're living. But we design these in such a way where you can utilize the money, as Teddy was saying. That cash value bucket can be borrowed against. You do not lose it. So if I have, let's just say $10,000, Teddy. Let's say I have $10,000 in the bank in my checkings account. All right. And I have $10,000 in an LLA. I'm going to play hypothetical. I am not a banker, and this is not any type of advice or whatnot. This is my opinion here, but I have $10,000 in my bank and I'm going to borrow $5,000 of it. In the bank, there's really no such thing as borrowing. I'm going to go take $5,000 out of the bank. And then how much money am I going to have in the bank? 5,000, right? And that's going to reflect. Now the bank might give me some very minuscule percentage of growth on that money that they have inside of my checking account. But when I take that 5,000, that's 5,000 is left. Now, Ted, what happens if I come to you and you're my agent? We have $10,000 sitting in PUAs or my cash value bucket. And I tell you, hey, I would like to borrow $5,000. What happens in that account? Could you break that down?
Yeah, so you request the money through whatever carrier, and you request it through your policy, on your online portal or whatever. Takes a couple of days, maybe sometimes the next day even. They send you that money and use it for whatever. Pay it back however you want, whatever you decide to pay it back. You don't need to run your credit. Don't need to give your whole life story. You don't have to get no co-signers. And then here's the magic and the best part. And it's not magic, it's just reality, right? But the best part of it is it's like your money is just still there, not even ever being touched. Like, it's like if your bank were to just give you $5,000, say, here, go do what you want, pay it back how you want on your terms. Pay it back however you want. And the good thing is you can capture the interest like you're paying the bank. You can pay it back to yourself. And we help with all that. It may not be easy to understand, but that's why we do clarity calls, insight calls, and stuff like that, and strategy sessions. So really help you understand these things and bring you complete clarity. That's one thing you'll hear from us a lot is say clarity, clarity, clarity. And like Gabe mentioned before, it's mission over commission. We're not in it for a commission. We're trying to bring clarity to everybody. And this is all educational, right? Purposes. This isn't financial advice. It's just real life educational stuff that we went out and had to learn because the schooling system did not teach us, right? It's just real life experiences and what we've learned.
Thank you, Ted. So, as Teddy was saying, and I was saying, the Living Legacy account here at ArkStone Financial, it starts with one call. That call, we've named it the clarity call. Why? Because not only do you need clarity in education, but at ArkStone, we want to make sure that we're the right fit for you. And so we need clarity. Clarity whether or not we can help you, whether or not you're understanding, or potentially you already have specific numbers in mind. Maybe you were watching some other videos on YouTube and you've got this big IBC plan. Maybe you read a book, Becoming Your Own Banker by Nelson Nash. You have this idea. We want to make sure that we have clarity whether or not your idea and your goal will work. We are insurance producers. ArkStone has brokers, and so we will do what you want. But long before we do what you want, we will make sure that you are 100% clear in what the outcomes will be. There is no fog. There is no putting some wool over your eyes so that we can get a better deal for ourselves. It is only what's best for you and your family, what you want, your goals, and that starts with a clarity call. So as we get ready to land the plane here, we're going to go over one more time. I'll just kind of break down the whole life policy. Okay. You start with a base insurance cost. We have a PUA, or paid up addition cost. And what that means is I'm going to pay X amount of money for the cost of insurance. Then I'm going to be paying out of $1, let's say, we'll look at it at $1. 20 cents of that dollar goes to paying for protection. This is how we formulate our base foundation and policies. 80 cents out of that dollar is going into what we call a paid up addition, or the cash value bucket. Sometimes we have to add a term so that we don't mech and we don't end up having to pay taxes at the end of this or whenever we pull money out, right? That term fits in the base. It's over there. Right? That cost is in that 20%. So we'll design you something around a 20-80. Make sure you understand that. 20% base, 80% PUA. Anywhere you go, guys, it doesn't matter if you come to ArkStone. Here's another thing, right? If you do go somewhere else, bring us your policies. We'll review it for free. We don't charge. Jump on a clarity call. Let's give you some clarity. We'll send you back to your agent. We want to make sure that we are building the kingdom of God the right way. We're taking care of individuals. We want to make sure that you're stewarding your money well, and that if you are getting bum advice, that the individual who's giving you bum advice stewards their license well. So with that being said, again, the most important thing about a living legacy account a whole life is how much are you paying for protection versus how much are you putting into your cash value bucket. Don't forget that, guys. So the next episodes to come, we'll dive even further. We'll break down even more. We'll get into some internal rate of returns, the percentages of dividend payouts, what's a mutual, what's direct versus non-direct. There is so much education to be had, guys, and I'm very excited. This is just the first episode. So subscribe, click that notification bell down at the bottom. Make sure that you're on par. If you look in the links down below, you'll be able to see us. We're on X. We have Instagram, Facebook, TikTok. Go ahead and follow Teddy. He's got his own accounts there. The man is amazing. He will really dive into some faithful topics on top of, some health education as well. We are all about you here at ArkStone Financial. Dive in, click the link again, get yourself on a clarity call. If you have any interest, it's free. There's no obligation. We're not pushy. And then Ted, I'll just kind of end with letting you, give them your final spiel there. Let them know what you think. And we'll end it with that.
Yeah, guys, like Gabe said, first and foremost, if we brought you any type of education, clarity, or even sparked your interest and you just want to have a conversation, comment, like, subscribe, and ask some questions even. You know what I mean? And what do you guys want to learn about? Is there a topic that you guys want to hear that maybe we can elaborate and break down and really put it into context and not really make it hard? Like, you know, like if it was for me, I would want somebody to break it down in a way where I would understand it. Because I'm not going to say I'm the smartest guy, right? Because I'm not nowhere near the smartest guy. Like Nelson Nash, he kept mentioning that guy was. I would say he's a genius because he uncovered all this and he brought it to light, right? Doing what the Rockefeller said. But yeah, man, it's great. Thank you, Gabe. ArkStone Financial, you guys like, subscribe, hit that bell, and comment. You know what I mean? Let us know your thoughts, even if it's be real with us. We would love that. And remember, this ArkStone Financial, mission over commission, clarity first. Thanks, guys.
Thank you, everybody. We'll see you on the next episode.